you're investing in stocks or mutual funds, you have the choice of large cap, mid cap or small cap funds. So what some people do is they just look at past returns. So if you look at 2023, large cap equity funds gave a return of 25%. Mid cap funds gave 40%. Small caps beat them all and gave 45%. So why not just invest in small cap funds and ignore everything else? Well, it doesn't work that way. In this episode of Question of Money, I, Aarati Krishnan, will tell you how you can mix and match large, mid and small caps and why you can't just stick to small caps. Now, the market price of a single share determines what a small stake in a company is worth on any given day. The market cap or market capitalization is simply the market value of all the equity shares of a company traded on a given day. Market cap is calculated by multiplying all the equity shares issued by the company by the current stock price. Now, one way to classify stocks and mutual funds is to go by their market cap. So, according to a SEBI definition, SEBI classifies equity mutual funds into large cap funds, mid cap funds and small cap funds. And funds that are classified within any of these market caps, they have to invest mainly in those stocks. So what is a large cap as per SEBI definition? The top 100 stocks by market capitalization are called large caps. The next 150 stocks are called mid caps and all the rest of the market is bucketed into small caps. Now, while market cap is a convenient measure to actually classify or categorize stocks, you should understand that it may not be an exact representation of a size of the company because it is based on the market value of a company. So, a company with large revenues or profits can sometimes fall in the mid cap bucket and a company with relatively small revenues or profits can go into large caps if the market is willing to give it a very high value. So, market cap is not a complete representation of a quality of a business or its growth prospects. Typically, sectors with large capital requirements like banking, steel, oil and gas, etc. will go into large caps because they have a large equity base and therefore tend to trade at a high market cap. Whereas even sector leaders in smaller sectors like say auto components or say ready-made garments or capital goods, they may only be mid caps or small caps even if they are pretty good companies which are leaders in their sectors. So while good businesses and good stocks to invest in may exist in any market cap segment, there are two ways in which large caps are superior to the other market caps. Firstly, because the large caps are actually the biggest stocks in the Indian listed universe, they attract a lot of institutions to invest in them. Therefore, when the market is down, etc., they tend to attract greater flows than the mid or small cap companies. Secondly, since these are the largest companies, they also get to raise funds pretty easily. This makes them more resilient to economic downturns or sector down cycles. This is in fact why for first-time investors or investors with low risk appetite, usually it is recommended that they start with large caps and move into mid caps or small caps only later in their investing journey. At the other end of the investing spectrum, small cap stocks and small cap funds face a lot of volatility in their earnings, their business, etc. whenever there is a downturn in the economy. Their stock prices can also swing very wildly because they have more retail investors and HNIs, etc. than institutional investors. So, in a typical market fall, if large caps fall by say 50%, then small caps in the same year can fall 70 or 75%. This is why to invest in small caps you need two qualities as an investor. You should be willing to take substantial capital losses which are much larger than any segment of the market. You should be prepared if you are investing in a real bull market to be prepared to lose 60 to 70% of your money even if a bear phase arrives. And once small cap fall, they also take a very long time to recoup their original value because when the next bull market arrives, it is against the large caps which perform first, the mid caps which go up later and small caps catch up in the end. Therefore, in order to recoup your losses from small caps also, you may have to wait much longer than with other market cap categories, something like 8 or 9 years. Therefore, you can invest in small caps only if you are willing to take capital losses and also wait a long time to make positive returns in case the market crashes. This is why no sensible advisor will advise that you put all your money in small caps, especially when a bull market has been on for some time like it is now. You need to mix and match large caps, mid caps and small caps based on your risk appetite and the horizon over which you are willing to hold on to your investment. So far in Question of Money episodes, we have been discussing a lot about mutual fund shares and how much returns they have given and so on. But suppose you have not invested even a single rupee in mutual funds or equities so far, all this must be giving a lot of FOMO to you. So where can you invest if you missed the entire rally in stock markets? Wait for the next episode of Question of Money to know the answer.